Here's the brutal truth nobody wants to admit. Your trading psychology problem isn't in your head, it's in your position size. You think you need more discipline, better indicators, or stronger willpower. Wrong. 90% of your fear, revenge trading, and blown accounts stem from one fatal flaw. You're risking money you can't afford to lose on every single trade. The amateur sees a setup and thinks, how much can I make? The professional asks, how much can I lose without breaking my process? This isn't just risk management, it's psychological engineering. When you risk 10% per trade, your brain enters survival mode. Every tick against you triggers fight or flight responses that evolved over 200,000 years. When you risk 1% per trade, those same survival circuits stay quiet, and you can think clearly. Let me show you exactly how this works with a real scenario. Take Sarah, a trader with a 50,000 account while was risking 50,000 account while was risking 5,000 per trade. She'd identified a perfect breakout pattern on NVDA at 420, with Astapat 420, with Astapat 410. Her risk was 10 per share, so she bought 500 shares. The moment she entered, her heart rate spiked. Every small pullback felt like disaster. When the stock dipped to 10 per share, so she bought 500 shares. The moment entered, her heart rate spiked. Every small pullback felt like disaster. When the stock dipped to 415, she couldn't think straight. Her palms were sweating. She was watching every tick like her life depended on it. Why? Because her brain knew that losing this trade meant losing 10% of her capital. Her amygdala, the ancient fear center, was screaming danger signals. She couldn't execute her plan because her nervous system was hijacked by survival instincts designed to keep our ancestors alive on the African savanna. Now watch what happened when she cut her position size to 500 risk per trade. Same setup, same stop, but now she bought 50 shares into 500. The psychological transformation was immediate. Her breathing stayed normal. She could think clearly. When NVD pulled back to 500 risk per trade. Same setup, same stop, but now she bought 50 shares into 500. The psychological transformation was immediate. Her breathing stayed normal. She could think clearly. When NVIDIA pulled back to 415, she felt nothing. No fear, no urge to exit early. She held through the pullback and rode the stock to $450 for a clean 7% gain. Jesse Livermore understood this fundamental principle decades before modern neuroscience proved him right. He didn't rely on motivation or meditation to stay disciplined. He built what he called the machine, mechanical responses that bypassed emotion entirely. When his system said sell, he sold. No internal debate, no second guessing, no hoping the market would be kind. Livermore knew that your subconscious mind can't tell the difference between losing $5,000 in the market and being chased by a predator. Both trigger the same ancient response systems. His famous quote, "There is nothing new in Wall Street," wasn't about market patterns, it was about human psychology. The same fear and greed cycles repeat because traders keep making the same position sizing mistakes. The machine worked because it removed the human element from trade execution. When the tape contradicted his thesis, he obeyed the tape immediately. That wasn't cold calculation, it was professional survival. Here's where most trading education gets it completely backwards. They tell you to develop discipline, control your emotions, stick to your plan. But they never address the root cause of why you can't stick to your plan in the first place. You can't stick to your plan because you're risking too much money. Your nervous system won't let you. Think about it this way. If you risked 10 per trade instead of 10 per trade instead of 1,000, would you still have trouble cutting losses? If you risked 0.1% of your account instead of 5%, would you still revenge trade after a loss? The answer is obvious. You'd execute mechanically because the financial consequences wouldn't trigger your survival responses. I've seen this transformation hundreds of times. A trader I coached risked 5% per trade and wondered why he kept breaking rules. He could quote every principle. Yet the moment price moved against him, he stared at the screen, paralyzed. bargaining with reality. We cut his size to 0.5%. Suddenly, his stop loss wasn't a threat, it was simple feedback. Within 2 weeks, his win rate improved dramatically, not because his entries got better, but because he stopped sabotaging his exits. Let me give you another concrete example that demonstrates the mathematics of psychology. Trader A risks 2,000 DONA, 2,000 DONA, 20,000 account, taking 10 trades per month. 2 early losers and he's down 20%. His next entries are late, exits are early, and he stops following his plan because he's in survival mode. Every subsequent decision is contaminated by the need to recover losses. Trader B risks $200 on the same account size, taking 20 trades per month. 4 early losers and he's down only 4%. He stays calm, keeps reading the tape, and nails the 5th trade at a pivotal point. By month's end, Trader B is up 6% with far less stress, while Trader A is praying for miracles or planning to quit. Same market conditions, different psychology engineered entirely through position sizing. This is why professionals think in percentages, while amateurs think in dollars. But here's the paradox that changes everything. You can rewire these responses in exactly 7 days, not 7 months of gradual improvement, 7 days of intensive reset, and that with given into cross. Most traders spend years fighting their instincts daily. Professionals know that dramatic psychological change happens through concentrated intensity, not willpower. The protocol works because trading psychology is directly tied to financial survival responses, and these responses can be rewired quickly through intensive, controlled exposure. Think of it like exposure therapy for phobias concentrated. Systematic desensitization works faster than gradual exposure. The 7-day reset systematically replaces emotional reactions with mechanical responses through specific daily protocols that build new neural pathways. Here's your immediate protocol. Cut your normal position size to 25% starting today. If you usually risk 1,000 per trade, risk 1,000 per trade. Risk 250. If you risk 2% of your account, drop to 0.5%. Set a daily drawdown kill switch at 2% of total equity, hit it. You're done trading for the day. No exceptions. No trading your way out. Why these specific numbers? Because they're designed to keep your nervous system below the survival threshold while maintaining enough skin in the game to care about execution. At these levels, losses become information instead of threats. When each outcome barely scratches your equity, your mind stops chasing certainty and starts following process. The counterintuitive truth that most traders never discover is this: smaller positions often generate larger returns because they enable perfect execution. You'll hold winners longer because you're not scared of giving back profits. You'll cut losers faster because small losses don't trigger denial. You'll take more high-probability setups because each individual trade matters less to your survival. The amateur wants to get rich on one trade. The professional compounds wealth through hundreds of small, well-executed decisions. Position size isn't just about money, it's about emotional bandwidth. Every dollar at risk consumes mental energy. Risk too much, and you'll micromanage every tick. Exit winners too early, hold losers too long. Risk the right amount, and you can execute your plan mechanically, with the detachment that profits require. Over the next 6 chapters, I'll give you the exact day-by-day protocol that transforms amateur emotional reactions into professional mechanical responses. But first, you need to understand why smaller positions create bigger profits, and why your current approach to trading psychology has been backwards from day one. The key isn't in your mind, it's in your mathematics. Cut your size today, and you'll feel the difference immediately. Your heart rate will normalize, your breathing will steady, your decisions will become mechanical. That's not coincidence, that's psychology engineering through proper position sizing. Day 1 starts with the most counterintuitive rule in trading. Cut your normal position size to 25% immediately. If you usually risk 1,000 per trade, today you'll risk 1,000 per trade. Today you'll risk 250. If you risk 2% of your account, drop to 0.5%. Your daily drawdown kill switch is 2% of total equity. Hit it, you're done for the day. No exceptions. No trading your way out. No heroic comebacks. This isn't gradual change, this is shock therapy for your trading psychology. The moment, if you implement this protocol, your nervous system will shift gears. When you drop from risking 5,000 to 5,000 to 500 per trade, something magical happens in your brain. The fear disappears. The greed quiets down. You start executing mechanically because survival anxiety switches off. Your prefrontal cortex, the rational decision-making center, can finally function without interference from your limbic system's panic signals. This is Jesse Livermore's machine in action. Mechanical responses that bypass emotion entirely. Let me show you exactly how this transformation works with Marcus, a swing trader I coached who was struggling with the same breakout strategy for months. Before the protocol, Marcus would spot a clean cup and handle pattern on AAPL, breaking above 180 resistance, with his normal 180 resistance, with his normal 2,000 risk per trade on a Seichuji 50,000 account. He'd buy 100 shares with a stopet, 50,000 account. He'd buy 100 shares with a stopet, 160. The moment he entered, his mind would start calculating. If this goes against me, I lose 2,000. That's 2,000. That's 4,000. 182 to 179. He'd panic and sell, convinced the pattern was failing. His win rate hovered around 179. He de-panic and sell, convinced the pattern was failing. His win rate hovered around 406,000 drawdown, 12% of his account gone. His brain treated every entry like a life or death decision because statistically, it almost was. After implementing the 25% rule, same setup, AAPL breaking 180, but now Marcus riskedly 180. But now Marcus riskedly 500, buying 25 shares with the same 160 stop. When the stock pulled back to 160 stop, when the stock pulled back to 179, he felt nothing. No racing heart, no sweaty palms, no urge to exit. He held through the pullback and rode AAPL to 1955 for a clean 8195 for a clean 850, zero risk. 3 losses in a row meant only $1,500 drawdown, 3% of his account. His subconscious mind finally relaxed because the financial consequences couldn't threaten his survival. The only thing that changed was his position size, but it transformed his entire psychology. This is why willpower fails and position sizing works. You can't think your way out of 200,000 years of evolutionary programming, but you can engineer around it. Day 2 introduces the burn list, 5 symbols you will not trade for 7 days. These are your emotional landmines, the tickers that have cost you money repeatedly. If TSLA took $1,200 from you last month, it's benched. If you've revenge traded NVDA 3 times this quarter, it's banned. If cryptocurrency triggers your worst decisions, every coin goes on the list. Professionals prune their trading universe ruthlessly. Amateurs chase the same losing patterns repeatedly, convinced they'll get it right next time. The burn list breaks this cycle by removing temptation entirely. Why does this work? Because certain symbols carry emotional baggage that contaminates your decision-making before you even enter a trade. Your brain has associated these tickers with pain, frustration, and financial loss. Sarah, another trader I worked with, had lost $3,000 on 3 separate AMZN trades over 2 months. Every time she saw AMZN setting up, her palms would sweat and her heart would race before she even considered entering. Her brain had literally programmed AMZN as a threat. By putting it on her burn list for 30 days, she broke the emotional association and could eventually trade it cleanly again. The burn list isn't permanent punishment, it's temporary rehabilitation. Think of it like avoiding alcohol during recovery. During these 7 days, you'll discover something profound. There are always other opportunities. The market provides endless setups across thousands of symbols. You don't need to trade your emotional landmines to make money. In fact, avoiding them often improves your returns because you're only taking trades with clean psychological states. Here's the deeper principle that most traders never grasp. Position size isn't just about money. It's about emotional bandwidth. Every dollar at risk consumes mental energy. Think of your brain like a computer processor. When you risk large amounts, most of your processing power goes to monitoring threat levels, calculating worst-case scenarios, and managing fear responses. Very little capacity remains for reading the tape, recognizing patterns, or executing your strategy. Risk too much, and you'll micromanage every tick. Exit winners too early, hold losers too long, and make decisions based on account balance instead of market structure. Risk the right amount, and you can execute your plan mechanically. Your mind stays clear and focused on what matters, reading price action, volume, and market internals. David, a day trader, discovered this when he cut his size from 3% to 0.75% per trade. Suddenly, he could see when institutions were accumulating shares during pullbacks, something he'd been blind to when his own survival was at stake. His entries improved dramatically because he could finally read the tape without emotional interference. When trades are properly sized, you can afford to be patient and wait for A-plus setups instead of forcing marginal opportunities. This is the essence of building your trading machine, creating an environment where emotion can't derail your process. The protocol is simple but brutal in its effectiveness. Smaller positions often generate larger returns because they allow perfect execution. Let me give you the exact mathematics. Trader A risks 3% per trade, takes 8 trades per month, and wins 60% of them. His average winner makes 4%, while his average loser costs 3%. When he hits his inevitable losing streak, 3 losses in a row, he's down 9% and panicking. His next 3 trades become emotional disasters. Late entries, early exits, revenge sizing. He ends the month flat despite having a winning strategy. Trader B uses the same strategy but risks 0.75% per trade and takes 16 trades per month. 3 losses in a row cost him only 2.25%. He stays calm, keeps following his plan, and compounds his edge over more trades. He ends the month up 5% with far less stress. You'll hold winners longer because you're not scared of giving back profits. When you risk 200 end of 200 end of 2000, watching a winner pull back from plus 400 to plus 400 to plus 200 doesn't trigger panic. You'll cut losers faster because small losses register as feedback, not failure. You'll take more high-probability setups because each individual trade matters less to your survival. The amateur wants to get rich on one trade. The professional compounds wealth through hundreds of small, well-executed decisions. This isn't just about preserving capital, it's about preserving psychology. When you protect your emotional bandwidth through proper position sizing, you can trade your strategy instead of your fears. Set up your environment to make discipline easier than impulse. Remove hotkeys for size increases. Preload your default order ticket with quarter size and your stop, loss distance. Set an alarm at minus 1.5% daily so you're never surprised by the kill switch. Those simple constraints protect energy for decisions that matter. And when nothing meets your criteria, you don't lower them. Waiting is a position. The market rewards patience with clarity. Clarity arrives at the pivotal point, not in the noise. Tomorrow, we tackle the hardest skill in trading, doing absolutely nothing when the market begs you to act. Day 3 will test everything you've learned about position sizing because the urge to overtrade becomes overwhelming when you realize how many setups you've been missing. But patience isn't passive, it's the most active position you can take. Day 3 is pure torture for most traders. No trades allowed. Your only job is watching, without acting. This sounds easy, it's psychological agony. You'll feel the urge to jump in dozens of times. Every green candle will whisper, opportunity. Every red candle will scream, bargain. That urge is exactly what we're rewiring. The moment you sit down to watch the market without being able to trade, Your brain will revolt like an addict denied their fix. It's been conditioned to treat every price movement as potential profit or loss, every setup as validation of your intelligence, every missed move as personal failure. Let me show you exactly what this looks like with Jennifer, a day trader who couldn't sit still for 5 minutes without placing an order. She averaged 47 trades per day, most of them break even, or small losses that slowly bled her account. Her commissions alone were eating 2% of her account monthly. On day 3 of the protocol, she watched SPY break above a key level at 10:47 a.m. with strong volume. Every instinct screamed, buy now or miss it forever. She wrote down the setup, the time, her conviction level, and what she would have done. By 11:15 a.m., SPY had reversed and fallen below the breakout level. She would have lost 400 on what seemed like a perfect setup. This happened 12 more times that day. Each can't miss opportunity turned into a potential loss. By market close, she realized her trading impulses would have cost her 400 on what seemed like a perfect setup. This happened 12 more times that day. Each can miss opportunity turned into a potential loss. By market close, she realized her trading impulses would have cost her 200 inches losses, plus commissions. The pain of watching without acting was nothing compared to the financial and emotional pain she'd been inflicting on her account daily through constant activity. Your brain will play vicious tricks during this process. It will convince you that you're missing the trade of the century. When NVDA gaps up 4% at the open, you'll feel physical pain watching it run without you. When TSLA breaks down through support, you'll be certain it's heading to zero, and you should short it immediately. These feelings are withdrawal symptoms from your action addiction. The amateur sees every price movement as opportunity, a chance to prove they're smart, to capture quick gains, to avoid missing out. They chase every flicker on the screen, convinced that constant engagement equals success. The professional sees most movements as noise, irrelevant fluctuations that obscure the true underlying trend and separate money from impatient traders. Jesse Livermore made his fortune not by trading daily volatility, but by identifying what he called pivotal points, exact price levels where major moves begin, and waiting months for them to appear. He understood that the market offers very few truly high-probability opportunities, and the vast majority of trading activity is simply churning capital. He famously said, "It was never my thinking that made the big money for me. It was always my sitting." This sitting, this deliberate inaction, is the hardest skill to master because it fights against every evolutionary impulse that kept our ancestors alive. But it's the bedrock of professional trading, psychology. Day 4 introduces pivotal point identification with surgical precision. These aren't vague support and resistance levels that every amateur draws with thick lines on their charts. A pivotal point is 50. 20 with Astopat 50. 20 with Astopat 49. 60. Not around $50. Why so precise? Because vague levels create vague decisions, and vague decisions create emotional trading. When your entry point is around 50, Thanat 50, Thanat 50, 10, you'll feel uncertain. At 49.90, you'll wonder if it's still valid. That ambiguity opens the door for emotions to override your plan. But when you say, I'll buy at 49.90, you wonder if it's still valid. That ambiguity opens the door for emotions to override your plan. But when you say, I'll buy at 50.20 with a stop at $49.60, there's no room for interpretation. The market either hits your level or it doesn't. You either take the trade or you don't. Here's your exact protocol for day 4. Mark 3 pivotal types on every chart you monitor. First, breakouts above resistance, with confirmation not any breakout, but a break above a level that's been tested at least 3 times, with declining volume on each test, followed by a decisive break with 1.5x average volume. Second, breakdowns below support with the same volume criteria in reverse. Third, First pullbacks after decisive moves when a stock breaks out strongly, pulls back to test the breakout level once, and holds with good volume. Use if-then statements for everything. If AAPL breaks 180, 50 on 1. 5. X average volume and holds for 5 minutes, then enter with stop at 180, 50 on 1. 5x average volume and holds for 5 minutes, then enter with stop at 178, 90. If it fails any part of that criteria, you log it and wait. Waiting is still your position. The power of this precision hit me when I watched Tom, a futures trader, identify a pivotal point in crude oil at 75.2. He'd been watching that level for 3 weeks as oil kept bouncing off 75.2. He'd been watching that level for 3 weeks as oil kept bouncing off 7.5, 15, and failing to break higher. Volume was declining on each test, showing sellers were getting exhausted. When oil finally broke 75.20 with massive volume, he entered immediate with Astapat 75.20 with massive volume. He entered immediate with Astapat 74.80. The trade ran to 82.50 over the next month, 82.50 over the next month, 7,300 profit per contract. While other traders were scalping for nickels and dimes in the daily noise, Tom made a month's worth of profits because he waited for the pivotal point where probability shifted decisively in his favor. This patience pays exponentially when you find the right setup. I know a currency trader named Marcus who made $2.1 million on a single British pound trade by waiting 11 months for his pivotal point. He'd identified that the pound was in an unsustainable position against the dollar, sitting at artificially high levels due to central bank intervention. He mapped the exact level where a breakdown would confirm 1.285 and calculated that a break below with volume would trigger algorithmic selling and force stops. For 11 months, he watched the pound test that level repeatedly, each time bouncing with decreasing conviction. He studied every Bank of England statement, every economic indicator, every technical pattern. When Brexit uncertainty finally pushed the pound through 1.285 on massive volume, he was positioned with maximum size while everyone else was caught off guard. The pound crashed 800 pips in 3 days. Marcus had turned 11 months of patient preparation into generational wealth, while amateur traders had churned their accounts hundreds of times, trying to catch every minor swing. The psychological transformation during these 2 days is profound but uncomfortable. You'll experience withdrawal symptoms as your brain adjusts to not acting on every impulse. This discomfort is necessary. It's rewiring neural pathways that have been reinforced by years of impulsive trading. Your reduced position size from days 1 to 2 makes this patience possible, because each missed opportunity doesn't feel like financial suicide. When you're risking 200 end of 200 end of 2000, you can afford to wait for perfect setups instead of forcing marginal ones. By day 4, you'll start feeling what real patience means. It's not passive waiting, it's active preparation for the moment when probability shifts decisively in your favor. You're not just sitting there. You're analyzing market structure, identifying key levels, and preparing your attack with surgical precision. You're building a mental database of high-probability setups and training your brain to engage only when those conditions are met. This is the art of strategic inaction, the ability to conserve your capital and emotional energy until the odds are overwhelmingly in your favor. You're becoming a sniper, not a machine gunner. Each bullet must count, and to make each bullet count, you must learn to wait for the perfect shot. The amateur feels compelled to trade constantly. The professional feels compelled to wait patiently. In that waiting, they find their edge. Tomorrow, we'll take these lessons of patience and precision and apply them to the most powerful tool in professional trading: learning to add to winning positions correctly, not chase losing ones desperately. Days 5 and 6 separate winning traders from losing ones. Learning to add to winners correctly. The amateur adds to positions because they're excited. The professional adds because risk improved after confirmation. This distinction determines who builds wealth and who gives it back? Most traders get pyramiding completely backwards. They add to losers, hoping for recovery and freeze when winners start moving. This is precisely why 90% of traders lose money. They're fighting probability instead of riding it. When you add to a losing position, you're doubling down on being wrong. When you add to a winning position correctly, you're compounding being right. The mathematics are brutal. Adding to losers creates exponential losses, while proper pyramiding creates exponential gains with decreasing risk. Here's exactly how clean pyramiding works with a 10,000 account. You buy 100 shares at 10,000 account. You buy 100 shares at 20, with a stop at 19.5. Risking 19.5. Risking 50, exactly 0.5% of your account from day one's protocol. Price breaks higher, retests 20, and holds with strong volume. This retest is crucial. It proves buyers are still in control and the breakout is legitimate. Your Azier stop toe 20, and holds with strong volume. This retest is crucial. It proves buyers are still in control and the breakout is legitimate. Your Azier stop toe 20, 10, locking in a small 10 profit. Now you add 50 shares at 10 profit. Now you add 50 shares at 20, 60 with the same 20, 10 stop, risking another 20, 10 stop, risking another 25 on the Ruddick. Addition. Total position, 150 shares. Total risk if stopped, 75. Buthers the magic your average risk per share actual improved. Your first 100 shares no risk only 75. Buther, the magic your average risk per share actual improved. Your first 100 shares no risk only 0, 10 each, while your new 50 shares risk 0,5. If the entire position gets stopped at 0,5. If the entire position gets stopped at 20,8, you make 10 on the first block and los, 10 on the first block and los 2, 5 on the second, for a net loss of only 15. You've increased your position size by 5015. You've increased your position size by 5050 to $15. Watch what happens as the move continues. Price pushes to 21.2, consolidates above 21.2, consolidates above 2, 1, and you add your final 25 shares at 21. 40 with your stop no at 21. 40 with your stop no at 21. 0. Total position. 175 shares. Average cost 20,6. Stopat 20,6. Stopat 2. 0. You're now risking virtually nothing on a position that could generate massive profits if the breakout continues. Meanwhile, the amateur who bought 300 shares at 20 with a 1950 stop is sweating bullets, risking 150 onazing entry point. If wrong, they lose 150 onazing entry point. If wrong, they lose 150. If right, they make whatever the move gives them. But you've engineered a position where being wrong costs almost nothing, and being right could make you wealthy. Day 5 protocol is ruthlessly specific. 3 additions maximum, only on continued confirmation, never into pullbacks. Each add requires 4 conditions. New price high with volume confirmation, ability to raise your stop without increasing total dollar risk, position size that shrinks with each addition, and total risk that stays under your original cap. Price confirmation means the market makes a new high and holds above the prior breakout level for at least 5 minutes. Volume confirmation means at least 1.3x average volume on the expansion bar. Your additions should follow this pattern. First position 1x your base risk, second addition 0.75x, third addition 0.5x. You're rewarding the market for proving your thesis, while respecting that extended moves face increasing mean reversion risk. The amateur adds on hope. The professional adds on proof. Sarah, a swing trader I coached, discovered this trading AMZN through a major breakout from 3,200. Her first entry was 50 shares with a 3,200. Her first entry was 50 shares with a 3,000. 150 stop, risking 2,500. When AMZN push toe, 2,500. When AMZN push toe 3,000, 280, and held above 3,000, 250 on their test with rising volume. She added 5 shares at 3,000, 250 on the retest with rising volume. She added 5 shares at 3,000, 290 with her stop moved to 3,000, 260. Her total risk decreased to 3,000, 260. Her total risk decreased to 2,000, 125 while her profit potential doubled. When AMZN ran to 3,500, she made 3,500. She made 18,750. Instead of the $15,000 she would have made with a single entry. More importantly, her psychology transformed. Each successful addition built confidence in her analysis and execution, creating positive reinforcement loops that compound over time. The psychology behind proper pyramiding is counterintuitive but powerful. When you add to winners, you're training your brain to expect success and follow probability. When you add to losers, you're programming yourself for failure and teaching your subconscious to fight the market's verdict. Each successful pyramid creates neural pathways of confidence and mechanical execution. Each time you average down into a loser, you reinforce desperation and poor judgment. This is why professionals feel calm when adding to winners. They're following probability with defined risk. Amateurs feel anxious because they usually add to losers, fighting against clear market feedback. Day 6 introduces the confirmation trap that destroys more accounts than any other psychological error. Most traders wait for confirmation after they spot a setup, seeking validation from the market before committing capital. They want to see the stock hold above resistance for 3 days, or break through a round number, or get analyst upgrades. By the time they get this comfort, the move is half over, and risk-reward is terrible. The professional acts at the pivotal point and uses the stop-loss as confirmation if, stopped out, they were wrong, and the market provided immediate feedback. If the move continues, they're positioned from the beginning with optimal risk-reward. Let me show you this principle with Tesla's massive run from 400 to 400 to 800. Mark, a professional trader, identified 400 as the pivotal point where Tesla was breaking good of a 6-month consolidation with declining volume on each chest. Amateur traders saw the same as setup but waited for confirmation. They wanted to see Tesla hold above 400 as the pivotal point where Tesla was breaking good of a 6-month consolidation with declining volume on the test. Amateur traders saw the same setup but waited for confirmation. They wanted to see Tesla hold above 450 or break 500 or show 3 consecutive days of gains. Mark bought at 500 or show 3 consecutive days of gains. Mark bought at 400 with a stop at 380, risking 380, risking 20 per share. His risk was defined and small. If wrong, he'd lose $20 per share quickly and move on. While others debated whether the breakout was real, he was already positioned and preparing to pyramid. When Tesla hit 450, the amateur finally got their confirmation and started buying. But now their risk was 450. The amateur finally got their confirmation and started buying. But now their risk was 3040 per share for the same potential reward Mark was getting, with 20 risk. Mark had already raised his stop to 20 risk. Mark had already raised his stop to 420, locking in 20 per share profit, and was sitting in second position at 20 per share profit, and was sitting in second position at 460. By the time Tesla reached 500, Mark had a 3-tier pyramid. First entry at 500, Mark had a 3-tier pyramid. First entry at 400, second at 460, third at 460, third at 520. His average cost was 427. his stop was at 427, his stop was at 480, and he was risking virtually nothing on a position that had already banked significant profits. The confirmation seekers were just starting to buy at 500 with stops at 500 with stops at 450, risking $50 per share on a move that was already 25% complete. When Tesla eventually ran to $800, Mark captured the entire 100% move with minimal risk, while the confirmation seekers caught only the final 60% and risked far more capital doing it. This isn't about being smarter or having better analysis. It's about understanding that confirmation is a luxury you can't afford in trending markets. Every day you wait for confirmation is a day the move continues without you. Every additional point of proof you demand reduces your risk-reward ratio and increases the price you pay for entry. The psychological shift is profound. You stop needing the market to validate decisions before making them. You trust your analysis enough to act at pivotal points. Knowing your stop protects you if wrong. This mindset catches the moves others miss because you're willing to be wrong small to be right big. The confirmation seekers are willing to be wrong big to feel right temporarily. When you pyramid correctly, each addition is made from strength. You're already profitable and adding to success. When you chase confirmation, each entry is made from weakness. You're paying higher prices for deteriorating probability. Most traders reverse this logic entirely. They'll buy a breakout at 50, watch it fail to 50, watch it fail to 45, and add more shares because it's cheaper. They'll buy more at 40, convinced they're averaging into value. By 40, convinced they're averaging into value. By 35, they're down 30% on a position 3 times larger than planned. Meanwhile, the professional who bought at 50 with a 50 with a 48 stop was out at $48 with a small loss and hunting for the next high probability setup. This is why position sizing and pyramiding are inseparable. They both require acting on probability rather than hope. Tomorrow, we complete your transformation with the most advanced concept in trading psychology, thinking in probabilities rather than predictions, and integrating everything into a systematic approach that works regardless of market conditions. Day 7 completes your transformation with the most advanced concept in trading psychology, thinking in probabilities, not predictions. The amateur tries to predict what will happen, analyzing charts for certainty, seeking confirmation that their directional bias is correct. They need to know whether the stock will go up or down, by how much, and when. This need for certainty destroys accounts because the market never provides it. The professional calculates what might happen and positions for the highest probability outcomes while protecting against disasters. They don't predict, they prepare for multiple scenarios and profit from whichever one unfolds. This fundamental shift, from prediction to preparation, separates consistently profitable traders from the 90% who lose money. Your Day 7 protocol synthesizes everything you've learned. One trade using 25% position size from Day 1. Predetermined pivotal points from Day 4, mechanical stops, and probabilistic thinking. But before you even consider entry, you must write 3 scenarios with mathematical precision. Best case, worst case, most likely case. Define your exact response to each scenario before the market opens. If it moves favorably, where do you take partials? At what levels do you raise your stop? How will you pyramid if conditions warrant? If it moves against you, where exactly do you exit? No hoping, no praying, no bargaining with reality. If it goes sideways, how long do you hold before cutting the position? Let me show you this systematic approach with a concrete example. Sarah identifies AAPL breaking above 175 Asher pivotal point, with Astapat 175 Asher pivotal point, with Astapat 172, using her 50,000 count and 50,000 count and 2575, 0 total, buying 250 shares. Her 3 scenarios are precisely defined. Best case, AAPL breaks 175 with volume above 1, 5x average, Runsto 175 with volume above 1, 5x average, Runsto 182, within 3 days. She'll take 100 shares off at 180. Raises stop to 180. Raises stop to 176 on remaining 150 shares. Trail with prior swing lows if it continues higher. Worst case, false breakout. Immediate reversal below 175. Sheik sits at 175. Sheik sits at 172 for exactly 7.50 loss. No exceptions. Most likely case, BAAPL breaks higher but consolidates between Septina Shimtai. Penkias de Shimplos. No exceptions. BAAPL breaks higher but consolidates between Vienna's Shimtas Septinis de Shimt. Benki Vienna's. Shimtas Septinis de Shimtas Tuoni. For 2 days before next move. She holds with original stop unless it fails to make progress after 48 hours, then exits at break-even to preserve capital for better opportunities. When AAPL gaps up and breaks 175.30 on strong volume, Sarah enters mechanically. She's not predicting that AAPL will definitely run to 175.30 on strong volume. Sarah enters mechanically. She, Stanbast, generally 1, Stanbast, not predicting that AAPL will definitely run to 182. She's positioning for that possibility while protecting against being wrong. When AAPL hits 179 the next day, she takes partial profits in 100, shares as planned. Banking 179 the next day, she takes partial profits in 100, shares as planned. Banking 925. Her remaining 150 shares have their stop raised to 176, guaranteeing a profitable trade regardless of what happens next. AAPL eventually reaches 176, guaranteeing a profitable trade regardless of what happens next. AAPL eventually reaches 183, and she exits the remainder using her trailing stop at 181 for another 900 profit. Total gain 1,825. 1,825. 7.50 risk. Excellent risk-adjusted returns achieved through systematic execution, not market prediction. This is what Jesse Livermore meant when he said, "The game taught me the game." Every outcome, win, loss, break even, provides data for future decisions when you approach trading systematically. Sarah's trade could have hit her stop at 1724, a 1724, a 750 loss, and that would have been equally valuable feedback. It would have taught her that AAPL wasn't ready to break higher, that volume wasn't sufficient, or that market conditions didn't support breakouts. The amateur sees losses as failures, personal inadequacies, or market manipulation. The professional sees them as tuition for market, education, necessary costs of doing business in a probabilistic environment. Here's the mathematical proof that process beats prediction. Trader A focuses on directional accuracy, achieving 60% win rate but risking 3% per trade with emotional exits. Average winner, 2%, exits early from fear. Average loser, 3%, holds hoping for recovery. Over 100 trades, 60 winners por 2%, igual a 120% gains. 40 losers por 3%, igual a 120% losses. Net result, break even minus commissions. Trader B uses probabilistic thinking, achieving only 45% accuracy but risking 0.75% per trade with mechanical execution. Average winner, 4%. Systematic hold. Average loser, 0.75%. Immediate stops. Over Vienna's Shimtas Trades. Keturias Penki winners Keturi%. Vienna's Shimtas Ashtuanias 10% gains. Penkias Penki losers Ketnuris Kablelis Septinias Penki% losses. Keturias Vienna's Kablelis 20% losses. Net result. Plus Vienna's Shimtas 30 Ashtuani Kablelis Septinias Penki% profit. Lower accuracy, higher profits through superior process management. Your edge isn't predicting direction, it's managing risk, sizing properly, and executing mechanically. The market will remain unpredictable. Earnings, reports surprise, Central banks pivot unexpectedly. Geopolitical events create volatility. Algorithms cause flash crashes. No analysis can predict these events or their market impact. But your response can be systematic. You can't control what the market does, but you can control your position size, your risk per trade, your exit criteria, and your emotional state. These controllable factors determine your long-term results. But here's the final paradox that transforms everything. The moment you stop needing to be right about market direction is when you start making consistent money. This psychological shift is profound and liberating. Most traders are addicted to being right. They hold losing positions because admitting they're wrong feels like personal failure. They exit winning positions too early because they want to lock in the validation of being correct. They revenge trade after losses because their ego demands vindication. When you embrace probabilistic thinking, being wrong becomes irrelevant. You're not trying to prove your intelligence to the market. You're responding to probability with predetermined actions. Here's your Day 7 implementation checklist. Pre-market. Define market context. Note trend on higher time frames. Mark economic releases that could affect your setup. Setup identification. Choose one. A+ setup at a pivotal point identified during days 3 to 4. Ignore everything else, no matter how tempting. Entry conditions. Set conditional entry with exact price and volume requirements. Mechanical stop loss at thesis invalidation point. First target at 1R, second target at 2R. Scenario planning. Write best case, worst case, most likely case responses on paper before market open. Risk management. Maximum 3 additions only on new highs with volume confirmation and raised stops. Total risk never exceeding original $100 cap. From position sizing rules. Exit protocols. Define invalidation level. Time stop if sideways action persists. And trailing. Methodology for extended moves. The psychological transformation is measurable and immediate. Your average loss decreases because you're cutting mechanically. Your average winner increases because you're holding systematically. Your trading frequency decreases, but profitability per trade improves. Your emotional state stabilizes because each trade represents predetermined, manageable risk rather than survival threat. You'll sleep better, think clearer, and execute with the calm precision that characterizes professionals. Integration of all 7 days creates your complete trading machine. Day 1's position size reduction eliminated survival mode psychology. Day 2's burn list removed emotional landmines. Days 3 to 4's patience training broke action addiction and identified true pivotal points. Days 5 to 6's pyramiding protocol taught you to add to strength, not weakness. Day 7's probabilistic framework completes the transformation from reactive amateur to systematic professional. Each component reinforces the others, creating a psychological framework that compounds edge over time. One crucial warning as you complete the reset. Success on Day 7 can intoxicate. You'll be tempted to restore full position size immediately, to make up for lost time. Don't. Extend the 25% sizing for another 2 weeks minimum. Let the machine settle and prove itself across multiple market conditions. Scale up only with rules. 25% to 35% after 20. Log trades with 90% stop adherence, then to 50% after another 20 trades with 0 revenge entries. Amateurs scale because they feel good. Professionals scale because the data supports it. Your trading journal becomes the feedback loop that maintains this transformation. Log every trade with 3 elements. Market behavior, what the tape showed. Personal execution, how well you followed your plan. And lessons learned, what to improve next time. 2 sentences per trade maximum focus on controllables like entry quality, stop placement, position sizing, and patience. Over time, this journal becomes an honest mirror, showing whether you're maintaining professional standards or slipping back into amateur habits. You've now rewired the fundamental psychology separating winners from losers. You think risk first, profit second. Before considering potential gains, you calculate exactly how much you're willing to lose and why. You act on probability, not prediction. You don't need to know what will happen. You need to know what you'll do when various scenarios unfold. You execute mechanically, not emotionally. Your responses are predetermined and systematic, removing emotion from critical decisions when money is at risk. The 7-day reset is complete. You've transformed from reactive amateur to systematic professional. Small losses are business expenses, not personal failures. The cost of doing business in a probabilistic environment. Patience is active capital allocation, choosing to deploy resources in waiting rather than forcing suboptimal opportunities. Waiting is a position because it preserves capital and emotional bandwidth for high probability setups. Your account will feel the difference immediately as win rates improve, losses shrink, and emotional stability increases. Cut losses fast, size positions small, wait for high probability setups. Own your process completely. These aren't just trading rules. They're the psychological framework that transforms gambling into systematic profit extraction. The market rewards those who respect its unpredictability while maintaining systematic responses. You are no longer the amateur who needs market validation for every decision. You are the professional who lets rules handle the heavy lifting while probability works in your favor over time. If this reset has shown you the power of systematic psychology over emotional trading, the next lesson on advanced tape reading and market structure will deepen your edge even further. You'll learn to decode how institutional money reveals itself through volume patterns and price action, positioning yourself ahead of moves before they become obvious to retail traders. For now, complete day 7 with the humility of a student and the precision of a professional. You are rewired. Stay rewired.